Warren Buffett once said that the rule number one of investing is don't lose money. And rule number two is don't forget rule number one. For that reason, I like to invest in stocks that return a high percentage yield of capital to shareholders, preferably through dividends, but also through buybacks if they don't return through dividends. And the reason for this is that it reduces the speculative nature of the investment to a great degree, making it much harder for me to lose money in aggregate, especially if I diversify across a number of opportunities. And this is basically because if you're investing in a lower yield company that does not buy back much stock, does not pay much of a dividend, it needs to make up for that with significant growth. But growth is much harder to project, especially out 3, 4, 5, 6 years into the future, which you need to be able to do successfully to invest in a growth stock well, unless you're just doing short-term speculations with chart reading. And the reason that's much harder to project is because to grow at a really high rate for an extended period of time, you need to be able to continue to either have a rapidly growing market and maintain your market share or to take considerable market share. And that requires a lot of analysis and in-depth knowledge of the industry itself to be able to say, hey, this company is going to have a sustained advantage over its peers and be able to sustain that advantage to an extent where they're going to be able to grab a lot of market share from them. And that's really tough to do because management teams are always changing strategies, trying new disruptive technologies, doing different marketing campaigns, price promotions, etc. Additionally, macro factors can have a great impact on whether an industry continues to grow its total demand, its total revenue base, or it shrinks or remains stagnant. And so that takes a lot more analysis. Obviously, it can be done. Many have done it successfully, made a lot of money. And sometimes you just get lucky riding a wave, like say the AI boom. If you're just like, that's a hot thing, I'm going to chase it, and it runs for an extended period of time. Maybe you don't even have good reasoning, but you still get lucky and make a lot of money. Personally, though, I don't like to rely on luck. I like to rely on reason. And so for those reasons, if you're investing in stable companies, infrastructure businesses, utilities, REITs that have essential business models that are not going away anytime soon, fixed cash flows, they return a lot of cash flow to shareholders, it's much less likely that you're going to have to need all this deep industry insight or technological insight, et cetera, to be able to correctly predict the trends. And you can simply look at the valuation, say, have a high degree of confidence it's going to pay out this percentage yield each year. It's going to grow at this slow rate. And I look at the valuation and I can make a good estimate whether it's going to return a satisfactory return or not to me. And especially if you diversify, you take away some of the individual management risk, potential black swans impacting individual companies. And in aggregate, you're going to have a much more reliable total return performance over time. And so that's the approach I take. And so with that in view, today's video, I'm going to discuss two companies that I think are really attractive along those lines because they combine attractive dividends with pretty significant buyback programs that create a high cash return for investors. Before I get into these names, though, if you could please give the video a like, I'd greatly appreciate it. Help with its distribution. Thank you so much. Okay, so the first company I'm going to discuss today is Morgan Stanley Direct Lending. And I've mentioned it on some of my previous videos. It's a business development company, which means it loans primarily money to middle market businesses, has a diversified portfolio of over 200 of them that it loans to. So each position is quite small. So if one of the companies goes bankrupt or has financial difficulties, it's not a huge devastating blow to the portfolio because it's just a very small percentage. So you get that nice diversification. It's basically a way to think of it. It's like a closed-end fund or some kind of ETF for loans to middle market companies. And so it's like investing in a diversified bond fund of sorts. Now, these loans are unique in that they're almost all floating rate. So therefore, and they're indexed to short-term interest rates. And so it gives nice diversification for your portfolio because most high-yield companies like REITs, utilities, infrastructure companies, renewable yield cos, MLPs, they all have long-dated, generally fixed cash flows that they generate from their contracts, or at least fairly fixed, maybe has some contractual escalators in there. And so they're more bond-like in nature. And so they generally don't do as well when interest rates are rising. Whereas if the Fed is hiking rates, BDCs tend to do better. Now you may be saying, wasn't the Fed on a rate cutting cycle? Well, it is, and that's already been largely priced into the market. This gives you nice portfolio diversification because there is evidence to suggest that the Fed may slow its pace of cuts at a rate compared to where the market's currently pricing it in. And so that would be a benefit to BDCs because, again, the economy is showing more resilience than many expected with Trump being elected. Many think he's going to implement more pro-growth policies. If you look at his first term, the economy generally did pretty well. And so there's thought that maybe the economy is less likely to go into recession than if we had had a government that was more likely to tax heavily and regulate heavily. He's going to likely cut taxes on corporations. He's going to likely reduce regulation significantly. So that's likely to boost the economy more. Now, of course, there's a debate over tariffs. That's a whole other discussion. there are mixed opinions about that. But in general, people think that Trump's election is going to be overall on the net positive for the economy. The other side of it is that inflation has been remarkably sticky over the past month. We had CPI, we had PPI coming in at levels that were in line with or even higher than many economists expected. It's showing that inflation, if anything, is slightly accelerating again. Not much, not a ton to be worried about, but it's definitely not falling, and still, 70 to 100 plus basis points above the Fed's target rate of 2%, depending on which metric exactly you look at. And so, again, the Fed has a ways to go there to get the inflation rate down. It's not making much progress right now. And so there's an argument to be made that actually the Fed should stop cutting rates and wait to see further data. But even if they do continue to cut as the market expects, I would imagine it's probably made a pretty slow rate, and probably slower than the 100 to 125 basis points cuts over the next year that the market is currently pricing in. Again, unless inflation just the bottom drops out of it, we'll see what happens. But with that in mind, it's likely that actually it's a good scenario for BDCs, because we're going to have the federal funds rate remaining at a pretty high level. So the BDCs are going to be getting that nice high yield on their investments, while the economy should be at least on somewhat stable footing. And so their non-accruals probably won't spike. So I think actually the BDC space is a pretty good place to be right now. So I think Morgan Stanley Direct Lending, ticker symbol MSDL, is a great place to be for several reasons. One, it has 98% of its portfolio invested in senior secured loans. 96% of its portfolio is in first lien senior secured loans. The other 2% are in second lien senior secured loans. So one of the most defensively positioned investment portfolios out there. So even if, we go into a recession, they are in a pretty good place to minimize their losses, at least on a permanent basis. Whereas a company that's more invested heavily in equity or lower, junior debt is probably going to be more exposed to economic downturns. On top of that, they have a very conservative 40% loan to value on their investments. So there's a nice cushion there protecting them as well, in addition to them being senior in the stack. On top of that, they have one of the lowest fee rates of any externally managed BDC in the market, only 1% of total assets under management. And that's right now it's actually 0.75. Because they have a waiver in place. That waiver goes away in January, so 1% after that. They have one of the lowest incentive fee rates as well for the company meeting, profit levels, and they have a waiver on that in place too. That's obviously goes away in January, but it's also further lowers the rates. They have very strong insider alignment. Over 10% of the equity is owned by Morgan Stanley, which is the external manager. They have a good external manager. Morgan Stanley is a highly reputable financial institution that has a lot of data, proprietary data, has a lot of experience managing assets. So they're pretty good. They've done a good job keeping non-accruals at a very low level. They also have payment in kind, or PIK income is only 2% of their income, so one of the lowest in the entire sector. So that's also a very good sign for them. They had a roughly 10% base dividend yield that's covered by about 30% with net investment income. Meanwhile, their net leverage ratio is only like 0.9 roughly. And so they want to bring that up more to about probably a 1.1, 1.15 level. So they have further room to run there, which will further increase their net investment income per share, which will only grow their dividend coverage ratio, which will help offset any headwinds from Federal Reserve rate cuts in the coming quarters and even year. And so that bodes very well for the safety of their base dividend. On top of that, they've been paying out a special dividend because they're covering their dividend so much, their base dividend so well. They have that excess income that they need to distribute because they're a BDC, and to get that, maintain their pass-through entity status and corporate income tax-free status, they have to distribute that extra income. And so when you include the supplemental dividend, the yield actually goes to about 12%, which is incredible. And on top of that, they have a pretty substantial buyback program in place that's roughly 5% of the current market cap. And that programmatically kicks in whenever the stock trades at a discount to NAV adjusted for the dividend. And on top of all that, they only trade roughly, I think, at a very, very slight premium to net asset value right now. In comparison, Blackstone Secured Lending, which is probably the closest peer comparison to MSDL in terms of the portfolio structure, the fee that they charge, having a good external manager, et cetera, they trade at a nearly 20% premium to their net asset value right now. So that suggests that either BXSL is way overvalued, or Morgan Stanley, MSDL, they are way undervalued. The truth is probably somewhere in the middle. I'd say that probably they both deserve to trade at between a 5 and 10% premium to their net asset value right now. And so, again, I think there's upside potential for MSDL on a valuation multiple basis, in addition to the attractive dividend. And at the very least, they have a bigger margin of safety guarding against downside risk compared to some of their peers like BXSL or Ares Capital Corp and others that trade at a bigger premium to NAV. So for those reasons, I think MSDL is a great buy right now. The other stock that I really like right now is Newmont Corporation. Now, their dividend yield's a lot lower. It's only about 2.6%, I think. So it's only about a quarter of what MSDL's is. But they have a big buyback in place that's about 6 to 7% of their current market cap that they expect to execute just over the next 2 years. So if you combine their dividend, say it's nearly 5.5% over the next 2 years will be return of the current market cap through dividends, and another 6 to 6.5% via buybacks. We're looking at roughly a 12% combined yield, or say about 6% annualized yield being returned through dividends and buybacks. That's a very high yield for a blue chip mining company that specializes in gold and copper. In fact, Newmont, after its recent acquisition of Newcrest, and it's been jettisoning off some of its higher cost non-core mining assets to further prune its portfolio, when you account the fact that they're almost all in very low risk jurisdictions from a geopolitical standpoint in comparison to, say, Barrick Gold. It's had some issues in places like Mali with their rogue militant government, etc. It probably has one of the finest collections of gold and copper assets in the world when you can count, tier 1 categorization, low jurisdictional geopolitical risk, etc. They have a phenomenal portfolio, yet currently they trade at a discount to the net asset value of their mining portfolio. So you're getting to buy this pristine, well-diversified portfolio at a discount to its value. And on top of when peers like Anglo, ticker symbol AAM, and some other mining companies trade at big premiums to their net asset value, and Newmont has traditionally done that. In fact, just a few months ago, it traded at a premium to net asset value. It was over $50 per share. We actually sold our position then because we felt it was fully valued. And since then, it's pulled back by about over 20% now to about $40 a share. And so we've been loading up here around $40 a share, re-entering the position because we're bullish on gold over the long term. Many reasons for that. Biggest are huge fiscal deficits in the United States and much of the world, China, Europe, etc., Japan, huge debt burdens. The geopolitical risk is enormous right now, and that makes gold much more attractive relative to many other equity investments in Newmont. You get leverage exposure to the price of gold, and they have a very low debt balance sheet. They have, again, low geopolitical risks. So in the event of a war, say, between the U.S. and China, again, their gold mines should not be overly threatened by that, and the price of gold will likely spike as it typically does during geopolitically stressful times. They also have, again, a big exposure to copper, that we're very bullish on the long-term outlook for copper because of the electrification of the economy, and it's been deemed one of the, it's going to likely be in a shortage here in a few years, and it's been deemed really the metal of the 21st century because of that. But on top of that, we think that Newmont has a lot going for it because the market has been punishing it, despite gold soaring to all-time highs, despite Newmont being in many ways ahead of schedule and selling off at non-core assets, generating a lot of cash flow they're using to reach their debt targets. They've deleveraged quite effectively. They've been buying back stock aggressively and even hiked their buyback. And they have already achieved their $500 million projected synergies from the transaction, with additional room for more synergies to be able to be achieved. So they have a lot going for them. They've pruned their portfolio. They're ready to focus on cutting costs and being as efficient as possible. But the market is punishing them because they did have pretty high costs this past quarter that I think caught the market off guard. And some of that's due to, higher royalties because of the higher gold price. And so that's, offsetting some of the benefit from higher gold prices, though not even close to fully. But inflation from labor, from fuel, etc. But oil prices have come down. They're likely going to remain lower because of pro-drilling policies by Trump. And again, the labor costs are high, but they're making progress at simplifying their structure. They've been laying off even senior executives, reducing their number of departments in the business to try to cut costs there. There are many things they can do. There's increased automation taking place that will help offset some of these headwinds. And so, yes, there is a bit of a headwind there, but I think the market is way overreacting. And so I think there's a lot to like about Newmont because of its yield, its valuation. It should have valuation multiple expansion. And again, our bullish outlook for gold and copper, and Newmont provides leverage exposure to that with very high quality, fairly low risk assets. So there you have it. If you like these two stocks, or maybe even if you don't, if you thought this video at least was thought provoking and you'd like to see more of my content, I produce regular videos pretty much every week, multiple videos a week typically. So please subscribe to my channel if you haven't already. I'd greatly appreciate it. Give the video a like. Let me know in the comments below what you think of these stocks and any others that you want to talk about today. Thank you very much. See you next time.